Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Eric Hadik. Eric was first introduced to commodities futures in 1979. Eric is a trader and analyst who has been intimately involved with the markets for over 30 years. His first introduction to technical analysis came through Fibonacci mathematics and Elliott wave principle, and he began trading in 1982. However, it was not until he discovered the works of W.D. Gann and Gann's integration of biblical and natural cycles that Eric knew he had discovered his life's passion and purpose. He has performed technical analysis and training for multinational companies, banks, and brokerage firms. In 1994, Eric founded Inside Track Trading with the express goal of teaching and sharing his work with qualified and serious traders, informing and educating investors, and ultimately re-entering the field of managed futures. Hadik has been quoted in many publications such as Investors Business Daily, Barron's, USA Today, and the Wall Street Journal. Was a regular guest on the weekly show Inside Wall Street, and has made several appearances on CNBC. Welcome to the program, Eric.
Thank you. It's great to be here, Lance.
Well, tell me about your background. How did cycles pull you into the markets?
Well, I don't know that I could even say cycles pulled me in. I had really in high school, in my first job, my employer was dabbling in Ginnie Mae's and the silver market, and he knew that I had an affinity for numbers and for math, and he began to explain to me the futures markets, and it just kind of evolved from there. I'd say that once I started to look into them, my first exposure was to Elliott wave, and once I got hold of Prechter's books on Elliott wave, it was the momentum had started, and it's just been going since then.
That's a pretty intense introduction to the markets. And what was your first job? Most people, deliver pizza or something. How did you get exposed to commodities at your first job?
Well, I guess you could see a little correlation, but I went to work when I was 16 for a type of grocery store, but it was more focused on being a meat store, and so within a year or so I was a full-fledged butcher, and so it was working in a meat department, although the employer who introduced me to this didn't do any dabbling in cattle or hogs or anything related to the business, but I spent a few years in that realm, so it may be a little more involved than pizza delivery, but not much more glamorous.
Okay. So it seems like a lot of people struggle with cycles. Why is that so, and how is your approach different?
Well, I think part of it comes in with semantics and really defining what you understand cycles to be. So I think that some people struggle because it's too vague, and some struggle because they try to make it too precise. And by too precise, I mean when you look at those that computerize various cycles and do all this back testing and specific analysis, and then they spit out a cycle that's 26.469 days long or something, and it becomes a little hard to trade a cycle like that. It's someone trying to build It's almost like someone trying to build the ideal average family in America and beating their head against the wall because they can't figure out how to have 2.3 kids. It's one of those things that you have to leave some room, some margin of error and leeway, but also keeping it precise. And so I think it's finding that niche in between the two extremes that is very elusive when people view cycles, and it's also expecting too much from them. I don't think you can trade specifically off of cycles. and that there needs to be, especially in something like the futures markets where there's more leverage and much more risk, you need things that are far more precise than cycles.
How do you go about, and you threw a lot out there. So first, how do you go about constructing a cycle for a particular market? Does it vary from market to market? And how do you go about, step one?
Right. I understand kind of what you're getting at. And there are cycles that are different in different markets, and there are cycles that I treat as being very natural, very consistent cycles that apply to all the markets. Those that are more market-specific are often determined by observation and testing more than anything. And even in those cases, you have to be aware of when those cycles are starting to transition, because there's always larger cycles trying to exert their influence and smaller cycles trying to exert their influence. So it's a constant swinging between them. But one of the things that I will do is viewing recent past action. Like if I'm looking for an intermediate cycle that would, in theory, hold for a few weeks. It might determine a 2 to 4 week bottom, a 2 to 4 week top. I am going to pay a lot of attention to what a given market has done over the course of the last 3 to 6 months and over the course of the last 6 to 12 months, because a market will often exhibit a specific tendency. One fairly common thing you see in a lot of markets is that they will exhibit or demonstrate turning points on a 30-day basis. And so you'll have a market that starts topping on the 12th or 13th of the month, but you don't necessarily see that until it's happened a couple times. And so it becomes a pattern that actually projects future cycles, future turning points, as long as there's synergy with other cycles. I'll never go on just one cycle telling me something. I need to see several cycles like that, and the other more universal cycles that I referred to coming into play at a similar point in time in order to give it much credence, much credibility. So it's a combination of using recent action to project future action, and also looking at cycles that, like a 40-day cycle is a very natural cycle, but also it's one that is very common in the markets. And really a 6-week cycle in the stock indices is one of the most common cycles and most ubiquitous. And for all intents and purposes, that cycle covers about 40 days. From the Monday at the beginning of the first week to the Friday at the end of the 6th week. And so there's, again, it's a combination, and if there's anything that really epitomizes or summarizes my trading, it's synergy, and it's needing to have multiple cycles and or multiple indicators giving the same conclusion before I will put much emphasis on them.
Okay, so it's not so mechanical as it is this discretionary, synergistic approach to cycles that you use.
Yes, I would. That's a pretty good summation.
Okay, so the second prong that you alluded to is you can't just trade on the cycles. So, and that's one of the appeal of cycles is, being able to look down the road and say, oh man, I know what's going to happen, so I'm going to back up the truck and fully leverage something. And you're saying no, you can't do that. So how do you take the cycles and then incorporate it with a trading strategy?
The cycles I use as a backdrop, as a timing tool, but only one timing tool. It's even how I treat certain disciplines like Elliott Wave. For me, they're a backdrop. They're a very crucial factor, but especially, again, in futures trading, even more so than just stock trading or longer-term investing of any sort, precision is very important, because if you're off by a few days or you're off by just a small percentage, the exponential factor of the leverage and the risk makes it far more dangerous. So I have very specific technical indicators, and even they are grouped into leading indicators, certain reversal signals that give me a very quick response to the cycles, and then some kind of intermediary, not quite lagging indicators, but ones that take a little longer to trigger. They're more like confirmation signals, and then more lagging indicators. So it's even a three-step process where if I get these signals triggering a reversal along with a cycle, I'll go with it, but I need to see confirmation within specific periods of time, because in many of those cases, I will be going against certain trends, more near-term trends, but from a trading standpoint, I try to keep most of those in the direction of a bigger overriding trend. So it is a combination of a lot of things, and I would never recommend trying to trade just off cycles. I think they are too general and leave a little too much room for error in order to be able to trade them successfully.
Mm-hmm. Well, let me paint you in a corner. What would you do if you had a cycle that said to expect a top, and you had an Elliott wave count that said you're in the middle of a third wave up, and that's all you were looking at? Which one of those would? So they're conflicting. You have two analysis tools that are conflicting. Which one would win?
Well, in the example you just gave, you're citing two schools of thought or two disciplines that I both treat as being kind of secondary or backdrop tools. I will tell my subscribers over and over again that, to me, price action is the ultimate filter. Mm-hmm. That we can discuss these cycles, we could discuss Elliott wave counts, but if price action says they're wrong, I go with price action.
Absolutely. So my question was a bad question.
Well, no. It's just the crux of it. I understand, and it's when there are things in conflict. I just want to specify that these price indicators that I alluded to there, discussed briefly, are the governing factor for me. And so if cycles and Elliott wave both are telling me one thing, but price action is either failing to confirm that or giving me a conflicting signal, I go with price action and go with these indicators, because also they give me very specific risk points. And that's what I think is the biggest weakness of cycle analysis, or even the way I approach Elliott wave analysis. It doesn't have specific enough risk points for me. So those I leave as a backdrop, and the price points, the price indicators, let me know where I'm wrong. It's much easier, it's much clear cut. If you're talking about trading, you need to. I emphasize that to my readers that first off, trading needs to be treated like a business. That we're not getting in it for excitement. We're not getting in it to try and do every trade. Not getting in it to trade a favorite market. It's looking for opportunities. It's just like any business. that doesn't chase every product or every cycle in consumer desires. They try to focus on the things that fit best with their business and are going to have a good profit potential for what they put into it. And so if you're going to treat trading like a business, you have to have specific money management principles, risk for what you were hoping to gain from trades. And so I will always defer to the technical analysis and those price indicators. One other point, though, when you mention if a cycle only appears to be half done and an Elliott wave count looks like there's more to it, that's an interesting corollary because in one of the indicators I developed, I call it the cycle progression, there is a point in a cycle where I expect it to invert, and that usually is equating to a third wave in an underlying Elliott wave. So a lot of cycles will oscillate between lows, and there might be, say, 4 consecutive lows, which actually correlate to specific waves, a 2-wave low, and then maybe what would it be, an A of a 2-wave, and then the final C of a 2-wave correction, and then maybe the 2 of the 3rd wave as the 3rd's breaking down. And then when a 3rd wave starts to enter its more dynamic phase, the cycle progression also inverts to where that cycle shifts to a high from that point forward, and then you'll see a succession of highs as maybe the 3rd of 3rd wave peaks, and then the 5th of the 3rd wave peaks, and then the 5th of the 5th wave peaks. And then your subsequent B wave peak coming off of the ultimate high. So you get a progression of highs, and then in theory, in the textbook case, that cycle will then again shift back to lows. So there is
just
that
like
period.
momentum oscillators.
Yeah.
So can you share any market views with us?
Well, probably my overall market view would be the most applicable, and a lot of it did have cycles as the governing factor. Since January of this year, longer term, I've been telling investors every month that I thought the stock indices would rally into the 3rd quarter, and that there were a lot of monthly, yearly cycles coming that were peaking at that time with the greatest synergy in September. And then as we even honed that down, the greatest synergy of weekly cycles along with monthly and yearly cycles came into play the week of September 17th to the 21st, which is when I thought we'd see a multi-month top, perhaps a top that holds for several quarters in the stock indices. That continues to be the prevailing analysis, and the outlook from there was I was looking for as much as a 20% drop leading into the next important cycle low in late January, early February of 2013. So that's kind of one prevailing cycle that we're kind of right in the midst of, and we've started to confirm that September cycle high, which gives me more confidence in the subsequent early 2013 cycle lows.
It's a timely forecast. How can listeners find out more about your research?
The easiest way is to go to our website, which is www.insidetrack.com, but I would specify the important thing there is that the word inside is actually an acronym, and so it has 2 I's in the middle. So it's INSIIDETRACK.com, and there's plenty of previous and sample publications posted there, and you can also go through our contact form and request free trials and current samples, which we will be happy to send out via email.
Excellent. All right. Is there anything you'd like to add before we go?
I don't think so. I think we covered a lot there, and I would just, again, emphasize the point that cycles and a lot of these indicators, you need to recognize both their strengths and their weaknesses to be able to use them effectively in trading, and probably more importantly, to recognize their weaknesses and know where that you shouldn't give them a lot of emphasis and shouldn't put too much faith or too much money behind them. So it's important to keep it as practical and as specific as possible.
Very good. Thank you, Eric.
Thank you.
Today's guest has been Eric Hadik, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.